Greetings to all our IMAPS clients and investors. Let me walk you through the changes made during the first week of July. The first semester of 2025 has been a period full of tectonic changes driven by pivotal fluctuations on almost all fronts. When we think about it, degrees of change are mostly determined by two factors, direction and magnitude. While direction was never a surprise considering the many promises of the Trump campaign, magnitude was the factor that ignited market uncertainty. The current perception is that we are past peak uncertainty regarding tariffs, the US fiscal budget, NATO relationships, immigration, and escalation of the Israel-Iran conflict. However, that does not mean that we are completely out of the woods yet. The next few months will likely continue to see additional air pockets which need to be navigated to get to the end of the year. Both the soft and hard data continue to show a deceleration in economic activity highlighted by a softer labor market as well as declining real estate and oil markets, all while we continue to wait for the inflationary impact of tariffs on the economy. It is important to be aware of the clouds on the horizon, but let us not forget our main investment thesis, which is based on the idea that the US economy remains robust as consumers continue to spend within the context of a healthy financial environment. The geopolitical landscape has experienced a meaningful tectonic shift. The US decision to strike Iran, effectively ending Iranians' race towards attaining nuclear weapons, is not only an incredible victory, but has also revealed that the axis of evil was much weaker than anticipated. Preoccupied with its own conflict with Ukraine, Russia was unable to provide military support to its so-called ally, while economically troubled China limited its intervention to publicly condemning the attacks on Iran. The US drivers to consider for the back half of the year are, on the fiscal side, the Big Beautiful Bill, which is expected to pass the Senate without substantial changes, while the final figures of the SALT cap and Medicaid cuts remain on a work in progress. The controversial section 899 will likely be removed from the bill. On trade, the last mile of tariff negotiations with major trading partners will likely cause market volatility over the next quarter, although the levels of tariffs is expected to converge with values that counterparties are going to be able to live with. The key expected tailwind will be the Fed's decision to cut interest rates. At this point, the market is already discounting a cut in September, as well as at least one more cut before the end of the year. While, according to our proprietary recessionary indicator, recession probabilities over the next 6 months keep lingering above 40%, the resilience and financial health of the US consumer will most likely allow the economy to either delay or successfully emerge from a possible recessionary environment. Following the premise of capturing rising opportunities in the broader technological space, the Disruptive Tech portfolio currently has a more diversified stock allocation than its blended benchmark. Portfolio diversification and cybersecurity allocation help to mitigate April sell-off and maintaining portfolio's performance. During the second quarter of the year, technology innovation, space exploration, semiconductors, and US technology outperformed the broader MSCI World IT Index. Cloud computing, robotics, and global large-cap growth were the lagging categories during the same quarter. The overall portfolio performance is in line with expectations, for which no changes to the portfolio were made during this quarter. We hope you are well, and always please reach out to your financial advisor or investment professional with any questions you may have. Thank you.